You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well on this Wednesday. Man, that goes so fast. All right, so today we are going to look into Imperial Oil and Canadian Natural Resources. The thing is, we got... I don't know, we got a lot of action as of late, right? With the bombarding of Iran, the specter of having a war brewing, a lot of bad stuff is happening out there, and that kind of propelled the oil price. The oil barrel was around $60 for a while. Now it jumped back around the 70s. It's still highly volatile, of course, but over the past, I don't know, since the beginning of the year, it's almost trading at its highest point right now. I mean, the highest point was in January around $77, $78. Now we're in the 70s. So I mean, by the time I record this and you listen to that, maybe we're going to get hit to 75, 77. Who knows? But one thing that caught actually some of my members' attention, because I had a private webinar 2 weeks ago, which is always one of the best moment of the month. So if you are a member at Dividend Stocks Rock, you have the possibility of sending me questions in advance, because every month besides summertime, I do private webinars for them. So I do the research and I find answers to those questions, and I explain stocks. We do comparison. We talked about the impact of the new bill that could possibly pass. I did the comparison between Capital Power and Brookfield Renewable, for example, last month. Talked about the Smith maneuver, private equity, and a lot of rapid fires about a lot of companies, what I think about it. And so long story short, an amazing moment where you get all your questions answered for a 2-hour session of webinar, and then you get the show notes and stuff, so you can follow that whenever you want. Anyways, long story short, we had that great question from Todd about the fact that Imperial Oil, ticker IMO.TO, and Canadian Natural Resources, CNQ.TO, they have a very, very similar business model, right? Both of them are vertically integrated, operating mostly in Canada, focused on oil and sand, but being present at each step of the transformation of the product, so able to make money the downstream, the upstream, and the upstream services. And there's something strange here. So while those two companies, and they're actually some of the rare businesses in the energy sector that are not cutting their dividend when there's a crisis, but rather keep increasing it, actually. So very stable, decades, more than 20 years each of dividend growth increases. But as of late, Imperial Oil has been performing a lot better than CNQ. So when you look about the past 2 years, roughly, Imperial Oil total return, so including the dividend, it's up 80%, and Canadian Natural Resources up 40%. So that was kind of strange. When you look at those numbers, okay, so why one is doing incredibly well and not the other? Not so sure, right? If you look at the past 5 years' performance, it's 465% up for Imperial Oil. Keep in mind, if you look at 5 years right now, we are in the middle of COVID. So of course, that was the perfect moment to buy energy stocks. They're not high growth companies like this forever. Keep that in mind. A lot of investors have bought Canadian Natural Resources over the past 2-3 years, and they have been disappointed. They were probably expecting double-digit growth returns year over year. It's not always the case. So anyways, 465 for Imperial Oil, Canadian Natural Resources 414. So I mean, it was not bad for Canadian Natural Resources, but still a 50% difference in total return. That's a lot. I mean, if I had to pick one, I would probably pick the one that gives me 465, right? So why Imperial Oil has been outperforming CNQ, especially since around July 2024. So the past 12 months, this is where you see that there's a big difference. So if you pull out like the graph, you'll see that both of them are following about the same trend, and then boom, around summertime of 24, Imperial Oil keeps on going higher and higher, while both of them are actually following a little bit more of the oil barrel fluctuation. Imperial Oil is always doing better. So I looked at the question and I was like, well, that's quite interesting. And if you look at the past 10 years, it's actually the opposite. So Imperial Oil was up about 200%, and then CNQ up 323%. So see how the lens of like the number of months or years when you look at total returns, I'm not saying that one is better than the other. Actually, two are great, well integrated and great dividend grower companies in the energy sector. So I just wanted to highlight how, depending on the lens that you put, depending on the numbers that you're like, the dates that you're looking, the numbers are going to be completely different. So going back to that explanation, actually I found something quite interesting. So when you look at Imperial Oil debt, it is like 3.5 billion, the long-term debt. And then when you look at CNQ, well, they made a recent acquisition about a year ago, and their total debt is at 17.4 billion. So right now, what's happening is, yes, both companies have about the same business model. They're great businesses, and it's a very strong balance sheet on both parts. But CNQ made additional acquisition, and not too long ago, they were like on the target to pay down their long-term debt below 10 billion, and then starting to increase their dividend massively and distributing that free cash flow. But they decided to buy Chevron's assets, spend a little bit more on that, and that's probably a pretty smart move for them to keep on growing, because you know that you have to maintain a high quality of assets going forward in the energy business if you want to keep continuing to like generate that free kind of cash flow. But you know, when you're making an acquisition, most of the time the acquirer, and we see that with Alimentation running after 7-Eleven these days, the stock price will drop because it creates more uncertainty. So for CNQ, you have the uncertainty around the acquisition and you have the uncertainty around the debt. So that probably could explain why one is doing a lot better than the other. It's just that Imperial Oil did not have this kind of like major news around the stock. Now going forward, does it mean that Imperial Oil will continue to be better than CNQ? I don't think so. I mean, I don't think the other one will necessarily be better either. But when you make acquisition, if everything goes right, you're going to make more money, right? So it means that you're going to be able to pay off your debt and you're going to generate more cash flow. And in the end, that will be what we call accretive. So you're going to make more profit out of all that stuff. So that would be a good move to keep the growth going. On the other side, when you don't make the acquisition, everybody's happy short term because you're thinking, oh, no risk, no more additional uncertainty on top of whatever we have right now. And of course, in this world, it's kind of crazy. But in the end, maybe the growth will be a bit slower later down the road because of that decision of not taking action today. Now, it doesn't mean that Imperial Oil will not take action in the future, but just wanted to explain a little bit more what's in the recent numbers, and not necessarily to put all the focus on like a few recent decisions or a few recent performance to determine which one is better. I think that the best way to approach this is to do a full analysis of both companies and then determine which one is best for your portfolio. On one side, if you look at the dividend triangle, you will notice that Imperial Oil has actually slightly better numbers than Canadian Natural Resources in terms of like revenue, earnings per share growth, and the dividend's about the same. The earnings per share growth is where there's a big difference. So we have like 25% for Imperial Oil. It is like very skyrocketing over the past 5 years. So just to keep that in mind, because Imperial Oil has stronger metrics and than CNQ and has a lower debt level. It is a bit smaller, to be fair, as well, but lower debt, so lower risk. They actually paid off their debt for a while now, so they're sitting at like a very comfortable level there. When you think about those two, probably that Imperial Oil shows a little bit better metrics, so that's probably a good reason to look at this one instead of CNQ. But in the end, both of them looks very great, very strong, and they are highing like more growth for the future. So if you want to make a play in the energy sector, I always say, well, focus on companies that have been able to maintain and at least or increase their dividend during bad time. And that's definitely what happened with Imperial Oil and Key Natural Resources. So, all right, Moose, that's enough for today. We're going to talk again tomorrow. And tomorrow we're going to talk about Power Corporation and Great West Lifeco. So stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.